Let's move to our next guest, top bond strategist, warning that the mega cap rally may be on borrowed time. He cites demand issues tied to tomorrow's 10-year Treasury Note auction. Ben Emmons is the head of fixed income and a senior portfolio manager at NewEdge Wealth. Ben, welcome. Talk us through this auction that is coming tomorrow on the 10 years. What you expect to see? There's going to be a lot of supply in the pipeline. Where's demand?
Yeah, that's the big question, Tyler. You know, if we know that China and Japan and other foreign investors have been not active in those auctions anymore for the last sort of 2 years, and now the banks too are not as active anymore. You know, they continue to sell treasuries. So who's going to step in here to buy it? You know, it probably is us, like a private sector or mutual funds. Now, we've been down in yield now about over 55 basis points over the past week, so there's a pretty good move. And to Steve's point, there probably was a lot of short covering. There was news out that right before the Treasury announced the supply, the hedge funds took even more short positions than before. And right as that supply number came out, all the covering probably has happened. So the setup for tomorrow is not that great, and the demand is unclear. So I think it's going to be a challenging auction.
So I think I heard Steve just say that you think rates are going to be lower, right? 4 months from now, 5 months from now. Do you see it that way or not?
It could be. I mean, you know, we have an economy that's from 5% slowing down in this quarter. And if that continues, ultimately rates should adjust to that path of growth down. I don't think, though, that we're going to go all the way back to 3%. I mean, for that, you have to see inflation really start to decline. And that has not yet been the case. And that's what we know from the Fed, too. They're hesitant to pull the trigger yet on any kind of rate cut. So I think we need to see somewhat more data before we can actually say we're a real trend down rate.
I guess, but there's a lot of supply coming, right? One way or another, there's a lot of supply coming. We don't know where the demand is, and some of the big players that have been supplying the demand are not going to be there. That would argue that rates could resume a rise upward, right?
Well, so if you look at the technical picture, Tyler, that's what it's indicating to me. Like, so we're sitting right at the 50-day moving average, and we're sort of building this support. We're staying in this really nice uptrend in the 10-year. If you zoom out, you look from since 2007 to now, and you take Fibonacci retracements, we actually should retrace all the way to 100% if we're going to stick here around this level, right? And if you believe in the technicals, you should actually see higher. Now, if you tie that to the demand-supply picture in the Treasury market not really resolved, then that leads you to that conclusion. Only, I think, as a last point, what we saw recently, we popped over 5%. There were buyers there. And I do think that if you're getting a bit of an overshoot on rates, there will be new buyers. It's just, at this point, this is not a good setup at 4.5.
Tim?
Well, I think it must be an interesting time for you, though. For the first time in probably 15 years, you're right in the spotlight of investors coming to you, really excited about yield opportunities. And I bet there's as much anxiety that yields are going to go down, and they're not going to be able to lock in these juicy yields. This is the conversation I have with clients all the time. And what I'm hearing from you is that the technical picture says, don't worry about it. You're going to get your spot. And if anything, you do not need to be locking in long term here, and that the yield curve actually may be a place to stay a little bit nimble and at the shorter end right now.
Yeah, I would fully agree with that view. I mean, the fact is actually we have now more or less like a flat curve, close to flat. And so why would you take all this 30-year risk and just get paid in the 2 to 5, 7-year part of the curve for the same return? If anything, there's actually even better opportunity to say like munis, which we'll
get there in a minute.
Get there in a minute. You know, these yields are really indeed attractive. So to your point, like, yes, we have clients too that are anxious. Like, I don't want to miss this moment, right? On the other hand, there's anxious about, well, this supply picture is still pretty troubling. You know, we could get a little higher here, but if it does get higher, it's a real buy opportunity.